In this lecture, I want to talk about how to take your trading signals, in particular your stop loss signals, from the underlying stock when trading a call option. So here we have a chart of Microsoft. We're in the middle of the coronavirus scare of 2020. We'll see how this turns out. But let's say you wanted to go long Microsoft right here. It's trading currently around 170. That's where it closed today, at 170.54. So let's say we see it here above the 50-day moving average, above the 200-day moving average, and we'd like to buy some call options on it and bet that the stock will continue to recover. So I would be, in this case, I would be looking about 60 days out, so we wouldn't have to worry too much about time decay. And I would try to probably, in the case of a blue chip like this, which doesn't move that much, I would probably be looking to buy 50 delta call options. So call options that are roughly at the money. So stocks trading at approximately 170. We can go to Yahoo Finance here, click on the options tab, and look about 60 days out. It's currently March 2020, so we'll look mid-May 2020. That's about 60 days out approximately. And we wanted to look at the at-the-money call options, we said. So these are the 170s right here. Let's just click on these. So they're currently trading at, let's see, they're bid at 955, offered at 985. Market's currently closed, but let's just say that we're going to be buying them right here from the, let's pretend the market's still open, we'll be buying them from the offer. So how do we do this? Well, looking at the chart, we say we like the stock here, but we don't think, we try to find a point of, a good point on the stock chart for our stop loss. So we can see here on March 2nd and March 3rd, the low of the day on March 2nd was 162.31. The low of the day on March 3rd was 162.26. So let's just stick our stop loss at 162.26, or you can pick a round number like 162. If the stock goes back down there, we can say that we were wrong about the trade. So what we will do is we'll buy the call option right here, and then if the stock goes down below 162.26, or call it 162, then we will exit our options, our call option. So when you're trading options in this manner, you don't want to take a stop loss based on the option price. So for example, if I enter at 985, it's very hard looking at a call option to know where you should put your stop loss. Should I put it at $8 here? Should I size it such that it's going to go to zero? Now, the very prudent thing to do is you can size this such that it might go to zero if there's a big overnight move. That's the worst case scenario. Probably not going to go to zero very, very quickly unless you get a huge overnight gap in Microsoft. But what I would do, I would buy it here at 985. And then I would hold the position until the underlying stock traded below 162.26 or 162, whatever point you pick on the chart. And so I'd be watching the stock price and using that to exit the call option. Now, how do we size this position? Well, I tend to size things fairly conservatively, especially if I'm going to do a large position. So what I would do in this case is, let's say I was trading a $50,000 account. So let's see, 50K account. I want to risk 2%, or I want to risk, let's call it, let's call it 2% to make the math really easy. So if I'm risking 2% on a $50,000 account, so I have $50,000 in my account. I want a 2% stop loss. So that's roughly $1,000. And so I would size it this way simply because if you're long a naked call, something bad could really happen. And especially now the VIX is very high, volatility is really high. And so we could see some of the premium, some of the extrinsic value, some of the time value coming out of the call options if we get a market recovery here. And the VIX goes down and the implied volatility of Microsoft options goes down as well. And so let's say we're going to risk $1,000 on this trade. Well, in that case, I can only buy one call option. So it's currently trading at 985. We use the multiplier of 100, and one call option here will cost me 985. That's pretty close to $1,000. I think that's roughly how I would size this in a $50,000 account. And then I know my max loss here is 2%. I probably will lose just a fraction of that. Maybe I would lose 50% of that, so call it approximately $500. And I will not, even though I'm sizing this based on 2% of my $50,000 account size, I will take my trading signal, my stop loss level, from actual prices on the stock chart of Microsoft, not on the options price itself. Hopefully that makes sense. Feel free to email me if you have any further questions about this. Thanks.